Welcome, curious minds, to the deep dive. Today, we're tackling something huge, something that's on, well, pretty much everyone's mind, achieving real financial security. You know, the kind that holds up no matter what the market decides to do.
Exactly. Forget the stress about retirement, the uncertainty. The material we're digging into today lays out a path. It promises a surprisingly simple strategy for potentially getting returns of 15% or more.
15% or more, and here's the kicker, with almost no risk. That sounds almost too good to be true in today's world.
It's a bold promise, definitely, but our sources break it down meticulously. And let's be honest, for a lot of people, a comfortable retirement feels, well, distant. The data shows that baby boomers, for example, average only about $50,000 saved. That's nowhere near the million they might actually need.
And younger generations are facing mountains of debt. It makes saving, let alone investing, feel almost impossible.
Right, so this deep dive really aims to cut through that anxiety. It's about providing a practical path, not just saving pennies, but genuinely growing wealth and doing it with confidence.
Okay, so this isn't about guesswork. We're trying to predict the next big thing. Our material introduces Rule #1 investing, a whole methodology apparently designed to be practically immune to the market's wild swings.
It's about investing with certainty. That's the core idea, and it feels revolutionary, doesn't it, in a world filled with financial ups and downs.
It really does. Certainty isn't a word you hear often with investing.
Well, the core belief here is that knowledge, when you really understand it and actually apply it, becomes your most valuable asset. We'll explore how this approach helps individual investors, the little guys, people like us.
Homemakers, teachers, small business owners.
Exactly. How they can actually outperform the so-called experts on Wall Street. And the best part, it uses tools that are readily available now, making informed decisions quickly. It's democratizing investing in a way.
So our mission today is to unpack this guide. We'll pull out the most important nuggets for you, the listener. We're going to look at why traditional investing often doesn't cut it, introduce the core ideas of Rule #1, and really give you the framework, the mental tools to approach investing differently, with more clarity, more confidence.
Precisely. We'll walk you through understanding what makes a business truly wonderful, how to spot it when it's selling at an attractive price, that's key, and crucially, how to manage your investments way more efficiently than you might think. You're about to discover a path to becoming really well-informed, ready to take control of your financial journey. Let's dive in.
Okay, we've set the stage for Rule #1. But before we build that new foundation, our source material insists we need to clear away some rubble first, some old ideas about investing that might actually be hurting us.
That's a great way to put it. So much conventional wisdom just doesn't hold up under scrutiny. A lot of people start out following it, and frankly, it often leads them down the wrong path.
Right. Like the idea of investing in low-risk government bonds for safety. The 10-year U.S. Treasury bond is often called the gold standard, right?
Yeah.
Maybe offering, 4%? Sounds super secure.
It sounds secure, absolutely. That's the appeal. But here's the fascinating part, the hidden cost. A 4% return. When you do the math, it takes 18 years just to double your money.
18 years.
Yeah. And here's the real kicker. Over those 18 years, inflation, even a modest 2 or 3% a year, eats away most of that gain. You end up with barely more buying power than when you started.
So safe doesn't mean you're actually getting ahead. You're just sort of treading water, financially speaking.
Exactly. It's safe in that you probably won't lose your initial investment, but it's often not sufficient for building real wealth, especially for retirement. It's a slow burn that can leave you short. You effectively lose purchasing power.
Okay, now for something really provocative from the material, it calls actively managed mutual funds, the ones trying to beat the market, a huge scam for the average investor.
Yeah.
That's a strong statement.
It is strong, no doubt. But the source backs it up with some pretty stark data. Fortune magazine looked at this, and since 1985, get this, only 4% of fund managers actually beat the S&P 500 index.
Only 4%.
Just 4%. And those few who did only beat it by a tiny margin. So basically 96% failed to do the one thing they're paid high fees to do, outperform the market.
So you're paying them for expertise that statistically isn't delivering better results than just buying a simple index fund.
Pretty much. Think about it. During the booming 80s and 90s, it was easy. The market went up, they looked good. But when things got tough, like the 2000-2003 tech crash.
Right, when good companies dropped like rocks.
Exactly, some down 90%. Their so-called usefulness just vanished. Investors lost huge amounts, but they were still paying those high management fees.
And part of their pitch is always diversification, spreading your money around. But the source criticizes that too. How does rule #1 see diversification?
Yeah, diversification, the idea of not putting all your eggs in one basket sounds logical, but the rule #1 perspective is that it actually guarantees you only average market returns, maybe slightly less after fees.
Because you're spread too thin?
Precisely. You own dozens, maybe hundreds of companies. You can't possibly understand or monitor all of them properly. And that, ironically, increases your risk because you might miss when one of your holdings starts to seriously falter. It violates the core principle, don't lose money.
Okay, another big one, the efficient market theory, EMT. The idea that stocks are always priced correctly based on all available information. Professor Malkiel even joked a monkey could pick stocks as well as Buffett if EMT was true. What's wrong with that theory from a rule #1 standpoint?
Well, the big question is, if the market's always efficient, why does it go crazy? Why do we have bubbles and crashes? Even Malkiel himself, after that 2003 debacle, admitted the market does go crazy from time to time.
Yeah, from time to time.
Right. And that's exactly what Buffett and Graham have said for like 80 years. In the short run, the market is a voting machine, but in the long run, it's a weighing machine. Those crazy times when the market votes incorrectly and misprices stocks,
That's the opportunity.
that's precisely the opportunity rule #1 investors look for. The so-called experts stuck on EMT often end up selling low when everyone's scared and buying high when everyone's euphoric. They play right into the hands of value investors who are patiently waiting for those mispricings.
Okay, last myth to bust. Dollar cost averaging, DCA. Investing the same amount regularly, regardless of price, to average down your cost. Seems sensible, but the source says it's not the lifesaver people think it is.
It has a couple of major flaws, according to our material. First, if the market goes sideways or down for a long time, and historically that happens.
Like those long stretches in the 20th century where the Dow basically went nowhere for decades.
Exactly. Think 1906 to 1942 or 1965 to 1983. In those periods, DCA is basically the same as buy and hold, and your return is essentially zero or worse. Decades of investing for nothing.
Ouch. What's the second flaw?
Second, DCA demands you keep buying religiously, even when the market is collapsing. Think 1929 or 2000, 2002. That requires two things many people lack in a crash: a stable income and the emotional steel to keep throwing money at something that's plummeting.
It feels like throwing good money after bad.
It does. Rule #1 is totally different. It's not about blind accumulation. It's about finding that dollar of value for 50 cents and buying only when that specific attractive price is available. It's targeted, not automatic.
All right, so we've cleared away some common investing myths. If those strategies are flawed, what's the alternative? The source keeps coming back to that first rule from Benjamin Graham, don't lose money. But it says rule #1 means more, it means investing with certainty. How on earth do you achieve certainty in the stock market?
Well, that certainly comes from a very clear foundational principle. You buy a wonderful business at an attractive price. Simple to say, but profound in practice.
Wonderful business, attractive price. Okay.
It fundamentally shifts your whole perspective. You stop thinking like a stock speculator, chasing prices on screen, and start thinking like a business owner. You're buying a piece of a real enterprise with people, products, buildings, future earnings.
Seeing it as owning a slice of the actual company.
Exactly. And when you adopt that owner's mindset, the focus naturally shifts from short-term gains to long-term value. Risk goes down because you're investing in something tangible you understand.
So how do we identify these wonderful businesses at those attractive prices? The source introduces this framework, the 4 MIMS, meaning moat, management, and margin of safety. Sounds like a checklist.
It is kind of, and it's like being a smart shopper. If you're the type who waits for that big sale to get a $5,000 TV for $2,500 because you know it's real worth,
You already have the right mindset.
you do. We're hunting for those exact situations in the stock market where a truly valuable, wonderful company is temporarily on sale because the market's having one of its crazy moments.
Yeah.
Recognizing value, then waiting for the discount.
Let's break down the MISC. The first one is meaning. This feels different, more personal than just crunching numbers. Invest in what you understand, what you'd be proud to own, what aligns with your values.
Absolutely. It's fundamental. To have certainty, to avoid losing money, you must understand what you're buying. Think about it. A business's future value depends on its future performance. How can you possibly predict that future if you don't understand how the business actually works?
Right. You'd just be guessing.
Pure guesswork. The source suggests this neat 3 circles exercise. List your passions, your talents, and how you make money. The overlap. That's where you'll likely find industries or businesses you instinctively get.
Like the author being a river guide, so he understood tourism businesses.
Exactly. He could easily grasp river touring, then connect it to safaris, even theme parks. That personal understanding prevents costly mistakes. Like investing in complex tech, you don't grasp something the author admits doing, and Buffett famously avoids. You don't need PhD-level knowledge.
Just enough comfort to feel like you could own the whole thing.
Enough comfort to metaphorically put your name on the business and expect to keep it there for the next 100 years. It's about that long-term owner perspective.
And that ties right back into the core mindset shift. Buy a business, not a stock. Why is making that mental switch so vital?
Because when you buy shares, you are buying a piece of the business. Thinking like an owner forces you to ask, if I owned this whole company, would I be happy? Would I be proud? It immediately stops you from speculating on short-term price wiggles and encourages real due diligence.
It makes it personal.
Deeply personal, and it connects to your values. If you think a company's product or practices are harmful, well, you wouldn't want to own that business, right? So you don't buy the stock. It acts as a powerful, almost automatic filter, ensuring your portfolio reflects companies you genuinely believe in for the long run.
Okay, so we found a business with meaning. We understand it. We'd be proud owners. The next M is crucial for determining if it's truly wonderful, the moat. What exactly is an investment moat, and why is it so important?
The moat is the business's competitive advantage. It's what makes it really hard for competitors to come in and steal customers or erode profits. Think of a medieval castle's moat. It provides protection.
Protection from what, in business terms?
Primarily from inflation and competition. A strong moat gives a company pricing power, the ability to raise prices, perhaps as its own costs rise, without losing significant business. It creates a kind of mini monopoly, even if it's not official.
And that pricing power leads to
Predictable, sustainable profits over the long term. Without a wide moat, a company is constantly battling rivals, cutting prices, fighting for survival. Its future is way less certain, its earnings more volatile. The moat ensures durability.
The force identifies 5 types of moats that create this advantage. Let's run through them with some examples we'd recognize.
Sure. First up is brand. Think Coca-Cola, Gillette, Disney, maybe Apple now too. People pay a premium for the name, the trust, the feeling associated with it. You can't just launch a new cola and beat Coke on price alone.
That brand loyalty is powerful. Okay, what's next?
Second, a secret. This could be a patent, like Pfizer has on drugs, or proprietary technology, or even a trade secret. Think 3M's innovation culture, Intel's chip-making know-how, or again, Coke's secret formula. It makes direct competition difficult or illegal.
Right, if nobody else can legally make what you make or doesn't know how, you're protected. What about controlling access?
That's the third type, a toll moat. These businesses control a market or essential service, so customers basically have to pay them a toll. Think local utilities, dominant newspapers in their regions back in the day, or maybe Google and Search now. You need the service, you pay the toll.
Okay, makes sense. What about companies that are just hard to leave?
Fourth is switching. These businesses are so integrated into a customer's operations or daily life that switching to a competitor is a major hassle, costly or risky. Think payroll services like ADP, tax software like H&R Blocks, or Microsoft's operating system. The pain of switching keeps customers locked in.
The inertia is their moat. And the last one seems pretty straightforward. Price.
Exactly. Number 5 is price. These companies operate so efficiently and at such scale that they can offer prices lower than anyone else can sustain. Think Walmart, Costco, Home Depot. Their cost structure is their moat, making it incredibly hard for others to compete profitably.
Now, having a moat isn't enough. It has to be sustainable. We're investing for the long haul, maybe 20 years or more. What makes a moat last? And what happens if it gets challenged?
That's a critical point. A moat requires constant defense. It's not a build-it-and-forget-it thing. Coca-Cola doesn't just rely on its recipe, it fights aggressively for shelf space and distribution against Pepsi. Microsoft constantly updates its software and services to fend off rivals.
Like Google trying to tunnel under its defenses, as the source puts it.
Exactly. Google built its own powerful moats, secret and brand, in search. The battle never ends. Companies have to innovate and actively protect their advantage. If they get complacent, even the widest moat can be breached over time, and the business stops being wonderful.
It's easy to look at a company with a strong moat and assume its stock price must also be great. But the source warns against confusing the quality of the business with the market's valuation of its stock. Why is that distinction so important?
It's a really common trap. A wide moat tells you the company is likely to survive and thrive for decades, generating predictable earnings. It does not tell you what the stock price should be today.
So a great company can be a terrible investment if the price is wrong.
Absolutely. The example given is Pepsi versus Coke in 1998. Pepsi was actually undervalued, while Coke, despite its amazing moat, was massively overvalued by the market. Pepsi stock went up, Coke's went down in the short term, yet their long-term returns over 25 years were almost identical.
Interesting.
It shows that even the best businesses can be priced irrationally high by Mr. Market, making them risky buys. Rule #1 investors identify those wide moat businesses, then patiently wait for the market to offer them at a significant discount. Patience and price discipline are key.
Okay, so we've got the qualitative side, understanding the business, meaning, and its competitive edge, moat. But investing also involves numbers. How do we actually quantify if a business is financially strong and predictable enough to be called wonderful?
Right, we need objective measures. That's where the big five numbers come in. These are 5 key financial metrics that, together, give you a powerful snapshot of a company's financial health and growth consistency.
The big 5. What are they, and what's the rule for them?
The golden rule is all 5 should ideally show a growth rate of 10% or more per year, averaged over the last 10 years. You also want to check the 5-year and 1-year trends to make sure growth is stable or accelerating, not declining. The 5 are 1. Return on investment capital, ROIC. 2. Earnings per share, EPS growth rate. 4. Equity growth rate, also called book value per share or BVPS. 5. Free cash flow, FCF or cash, growth rate.
10% growth across all 5 for 10 years. That sounds like a high bar.
It is, and that's the point. We're looking for consistently excellent businesses. While there are tons of numbers on financial websites, these 5 really distill the essence. And the good news is you can learn to calculate them from free online data or use tools the source recommends.
Now, you listed ROIC first. The source says it's the most important of the 5. Why does return on investment capital get top billing? What does it tell us?
ROIC is king because it measures how effectively the company uses all the money invested in its operations, whether that money was borrowed or came from owner's equity. It's basically the rate of return the business earns on its own investments.
Like how much profit the lemonade stand makes on the initial $200 investment.
Exactly. If they made a $100 profit, that's a 50% ROIC, way better than a bank account. A consistently high ROIC above that 10% threshold for 10 years is a huge indicator of 2 things. A strong moat, because the moat allows them to earn high returns.
And effective management, because they're deploying that capital wisely.
Precisely. Companies with great moats almost always have great ROIC because they aren't constantly getting squeezed on price. Comparing Whole Foods' growing ROIC back then to Albertsons' shrinking ROIC clearly showed who had the stronger moat and better capital allocation. It's the ultimate measure of internal business quality.
Okay, so ROIC shows how well the business uses its money. The other 4 are about growth. Let's quickly touch on what each tells us. Sales growth.
Sales growth rate is pretty straightforward. Is the company selling more stuff over time? It's the top-line indicator of demand. Are more people buying its products or services?
Makes sense. Earnings per share, EPS growth.
EPS growth rate is the bottom line. How much profit is the business generating for each share owned by investors like us? Growing EPS means the company is becoming more profitable for its owners.
Equity or book value growth.
Equity growth rate, or BVPS growth rate, reflects the growth in the net worth of the company attributable to owners. If you sold all assets and paid all debts, what's left? While the absolute number varies wildly between companies, asset-heavy versus intellectual property, the growth rate is key. It's considered the best proxy for the growth of the business's intrinsic value, its underlying worth, or sticker price.
And finally, free cash flow growth. How's that different from EPS?
Free cash flow, FCF, growth rate is vital because it shows if the company's reported profits, EPS, are translating into actual cash in the bank. FCF is the cash left over after the company pays for everything needed to maintain its operations. It's the real cash available for expansion, paying down debt, or returning to shareholders. Sometimes FCF can be lumpy, especially if a company is investing heavily.
Like Whole Foods building new stores.
Right. In those cases, you also check operating cash flow, which should be smoother and trending upwards, showing the core business is generating cash. You want real cash, not just accounting profits.
We're looking for consistency, that 10% growth across the board. What if the numbers are erratic? jumping all over the place. And what about debt? Is that part of the big five?
Inconsistent numbers are a big red flag. Think of General Motors' EPS back in the late 90s, early 2000s. It was all over the map. That signals unpredictability. If the past is erratic, how can you confidently predict a stable, wonderful future? We want certainty. So inconsistency is usually a pass.
Okay, move on if the numbers are jumpy. What about debt?
Debt isn't one of the big five, but it's a crucial check. The rule of thumb is simple. Can the company pay off all its long-term debt within 3 years using its current free cash flow? You just divide the total long-term debt by the annual FCF. If the answer is 3 or less, it's generally acceptable. More than that signals potential risk. Usually, if the big five look great, debt is under control, but it's a quick, vital check.
Calculating these growth rates sounds like it could involve some complex math, but the source mentions a shortcut, the rule of 72. How does that help estimate these rates quickly?
The rule of 72 is a fantastic mental math trick. To find the approximate annual growth rate, you just divide 72 by the number of years it takes for something to double. Or, if you know the growth rate, divide 72 by the rate to estimate the doubling time.
So if Garmin's equity doubled roughly every 2 years,
You divide 72 by 2, which is 36, so you estimate its equity growth rate was probably around 30-something%. It's not exact, but it gives you a quick ballpark figure without needing a spreadsheet. Online calculators give precision, but this is great for quick checks.
and in terms of importance for predicting future value,
The general hierarchy is ROIC first, then equity growth, then EPS, then sales, and finally free cash flow. But, and this is critical, you can't just rely on numbers alone. Remember the first M, meaning. You must understand the business, otherwise great numbers don't mean anything. You could get suckered into a story stock that looks good on paper but lacks a real understandable moat. Numbers support the story, they don't replace understanding.
Okay, we've covered meaning and moat, understanding the business and its defenses. We've quantified its health with the big five. Now for the third M, management, the jockey running the horse. Our source says great companies need great CEOs. What defines this level 5 management we could look for?
Level 5 management is all about CEOs who act like true owners, running the business as if it's their family's only asset, meant to last 100 years. This shows up in a few key ways. First, radical transparency. They're upfront about challenges, not just successes. Think John Mackey at Whole Foods openly discussing issues.
Not just spinning good news.
Exactly. Second, their compensation is aligned with shareholders. Warren Buffett earning $100, benefiting only when the stock goes up. Steve Jobs taking $1 when he returned to Apple. Their success is tied directly to the company's long-term success, not massive short-term payouts.
What about things like insider trading?
That can be a signal, yes. Legal insider trading, when reported, is public info. If top execs are consistently selling large amounts of their stock, think Enron, before the collapse, that's a huge red flag. Conversely, if leaders like Buffett never sell, it speaks volumes about their belief in the company's future.
So we want honesty, alignment, long-term focus. What are the warning signs of bad management, the mercenary CEOs?
You need to watch out for CEOs focused on personal enrichment over shareholder value. Look for outrageous perks, overly friendly boards, compensation loaded with stock options that dilute ownership without costing the manager anything directly, especially if it's not tied to long-term performance.
Like that Bristol-Myers Squibb example.
Right. The CEO taking $41 million while sales were flat and debt soared after a bad acquisition. That's mercenary behavior. If a CEO isn't telling the truth, isn't taking responsibility, or isn't clearly aligned with owners, rule #1 says, don't invest, period. Their integrity or lack thereof is critical.
All right, even with meaning, a moat, and great management, there's one more M, the final layer of protection. Margin of safety, or MOS. The source calls this possibly the most important M. What is it, and why is it so vital?
Margin of safety is your ultimate protection. It's the principle of buying $1 worth of a wonderful business for 50 cents. It's the buffer that protects you if your analysis isn't perfect, if growth slows unexpectedly, if things just don't go exactly as planned.
Because the future is inherently uncertain even with a great business.
Precisely. And we know markets aren't always rational, they go crazy. Businesses get mispriced. The MOS lets you exploit that mispricing when it swings heavily in your favor. Even Warren Buffett demands a huge MOS. If he needs it, we definitely need it.
So it's not just about finding a good company, but finding it at a truly great price.
Exactly. It's the core of rule #1. Don't lose money. Without a margin of safety, you have no cushion, no room for error. This isn't about buying cheap, junky, cigar butt stocks hoping for a final puff. It's about finding that Maserati business that has gone on sale. Quality first, then a deep discount.
Okay, so how do we figure out what that dollar of value actually is so we know what 50 cents looks like?
Right.
This leads us to calculating the sticker price, the intrinsic value, the fair price. How do we calculate that?
Calculating the sticker price is the core valuation step. It's all about projecting the business's future earnings potential. You need 4 key numbers. First, current EPS, get it from recent financial reports. Second, the estimated EPS growth rate, the rule #1 growth rate. Be conservative. Use the lower of the historical growth rate from the Big Five or analyst estimates. Project out 10 years. Third, the estimated future PE ratio. Again, be conservative. Use the lower of the company's historical average PE or simply double its estimated growth rate. Third, the estimated future PE ratio. Again, be conservative. Fourth, your minimum acceptable rate of return, which for rule #1 is always 15% per year.
Okay, current EPS, growth rate, future PE, and our 15% required return. How do we combine them?
You take the current EPS and project it forward 10 years using the estimated growth rate. The rule of 72 helps estimate this quickly. A 15% growth rate doubles EPS roughly every 5 years, so it quadruples in 10 years. A 24% growth rate doubles every 3 years, so it grows about 8-fold in 9-10 years. Then multiply that future EPS in 10 years by your estimated future PE. That gives you the future market price in 10 years.
Okay, that's the projected price in a decade. How do we get today's sticker price?
Because we demand a 15% annual return, which means our money must quadruple in 10 years, doubling every 5 years, we simply divide that future market price by 4. That's your sticker price today, the maximum you can pay, and still reasonably expect a 15% return if your projections hold true.
And the margin of safety price is half of that sticker price.
Exactly. Sticker price divided by 2 gives you your MOS price, the target 50 cents on the dollar entry point. It's a rigorous process, forcing discipline. You calculate the value, then wait patiently for Mr. Market to offer that bargain.
Let's walk through that Harley-Davidson example from early 2000 again. How did the numbers work out?
Right, great example. Analysts estimated 24% growth for Harley back then. Let's say current EPS was $0.75. Projecting that out 10 years at 24% growth, doubling roughly every 3 years, so a bit more than 3 doublings, might give you a future EPS around $7.50.
Okay, future PE.
Use the lower of its historical PE, 46, or double the growth rate, 2 by 24 equals 48. So we use 46. Future market price equals $7.50. Future EPS by 46, future PE equals $345.
And the sticker price today?
Sticker price, $345, 4 equals 86 cents. And the margin of safety price, MOS price equals 86 Party Laura's, 2 equals $43.
Yeah, the stock was actually trading at
$29 a share, way below the MOS price of $43. Clear signal. Mr. Market was panicking, offering a wonderful business at a fantastic price. Even though growth wasn't quite 24% later, buying with that huge MOS still led to a 100% return by 2005. It shows the power of the buffer. Buying mispriced quality works.
We figured out how to find a wonderful business using the 4Ms and buy it at a margin of safety price. What about selling? We hear buy and hold forever, but rule #1 seems to say not always. When do you sell a wonderful business?
Yeah, buy and hold forever is the ideal, letting compounding work. But reality intrudes. There are 2 main reasons a rule #1 investor must sell. First, the business stops being wonderful.
Meaning moat or management falters?
Exactly. Maybe there's an outside attack, a new technology makes its product obsolete, like digital cameras killing film. Or maybe an inside trader, a new CEO starts making dumb acquisitions, destroying value, acting like a mercenary. Either way, the Big 5 numbers will start to deteriorate. If the business fundamentals decline, you sell. It's no longer the wonderful business you bought.
So watch the fundamentals. What's the second reason to sell?
Simply put, the market price goes way above the sticker price. Even the best business can become wildly overpriced due to market euphoria. You need to recalculate the sticker price periodically based on current earnings and reasonable future growth. If the stock price zooms way past that calculated value, say 20% or more above sticker, it's time to sell.
Even Buffett admits he should have sold Coke in 1999 when it was insanely high.
Right. It's disciplined value realization. You bought low, now you sell high. The source suggests you might wait for the price to drop at least 20% below sticker again before considering re-entry. This active management, buying low and selling high based on calculated value, can significantly boost returns, like the Harley example showed. It's about moving capital to where the best risk-reward opportunity lies.
Okay, selling when the business falters or gets overpriced makes sense logically, but emotionally, selling when everyone else is buying or buying when everyone is panicking.
Yeah.
That's tough. The source talks about the emotional rule of investing, ERI. What is that again, and how does it mess us up?
ERI is that frustrating, irrational tendency we all have. It goes, if you buy this stock, it will immediately go down. If you don't buy it, it will go straight up until you finally cave and buy it, at which point it will immediately go down.
Oh, sounds painfully familiar.
Doesn't it? It's that emotional roller coaster of fear and greed that makes us second-guess solid, rational decisions based on the four M's. We hesitate, we chase, we panic. The four M's handle the rational reasons, but ERI is irrational. We need something else to combat it.
And that's where the tools come in. You mentioned the little guy has an advantage here. How do these tools work?
Yes, the tools are the antidote to ERI, and they give individual investors a real edge. See, the big fund managers moving billions create market signals with their slow, massive buying and selling. It takes them weeks to get in or out, visibly pushing prices.
They're the cruise ship, we're the wave runner.
Perfect analogy. We can zip in and out in seconds without moving the price, using the wake they create. We watch their movements. There are three key tools usually found on charting websites. First is MTD, Moving Average Convergence Divergence. Think of it like a momentum or pressure gauge. We use slightly faster settings than default to catch the big guy's initial moves.
How do we read the signal?
When the main XD line crosses above its slower signal line, often shown as bars turning positive or a mountain starting, it suggests big money is flowing in. That's a buy signal confirmation. When it crosses below, bars negative, valley starting, money's flowing out, a sell signal confirmation.
Okay, MCD confirms momentum. What's tool number 2?
Second is stochastics. This oscillator helps identify overbought, too many buyers, price might pull back, or oversold, too many sellers, price might rebound conditions. When its faster line crosses up over its slower line, especially from an oversold level, it's an early buy signal. Crossing down from overbought is an early sell signal. Stochastics often leads the other indicators.
Gives you a heads up. And the third tool?
Third, simple moving averages, MA. The source likes a 10-day simple moving average. Think of it as a short-term psychological price level. When the stock price crosses decisively above the 10-day MA, it breaks near-term resistance, a buy signal. When it crosses below, it breaks near-term support, a sell signal. It's often the last confirmation.
So 3 different signals. MED for momentum, stochastics for overbought, oversold, and moving average for short-term trend. How do we use them together?
The absolute key is you wait for all 3 tools to agree. Don't jump the gun on just one signal. You need confirmation. Wait for all 3 to flash buy before you buy, assuming the price is below MOS. Wait for all 3 to flash sell before you sell, or if the price is way above sticker.
Like the Starbucks and Apple examples,
Yeah.
the tools gave clear entry and exit points.
Exactly. Starbucks. Stochastics fired first, then MA, then MED confirmed the buy. Apple. All 3 signaled get out before the bad news hit, saving investors from a big drop. These tools provide objective entry and exit triggers, taking your emotions out of the driver's seat. They are your ERI protection.
Okay, this is incredibly empowering. We have the 4 M's to find wonderful businesses, the math to find the right price, and the tools to help us buy and sell without emotion. So if someone listening is ready to start. But the source warns about 5 common barriers that can stop people cold. What are they?
Right. Knowing the path is one thing, clearing the obstacles is another. The 5 big barriers are, first, bad debt. We're talking high-interest credit cards, personal loans for stuff that loses value. This debt works against you, compounding your losses. Rule #1, don't lose money. Paying off 20% credit card debt is a guaranteed 20% return. Get rid of bad debt before you invest a dime.
Makes sense. Barrier 2.
Taxes on gains. People get scared of paying taxes, so they hold on to a stock way too long, even when it's clearly time to sell based on fundamentals or price. Don't let the tax tail wag the investment dog. Use tax-advantaged accounts like IRAs, especially Roth IRAs, or 401ks whenever possible. If you have to pay taxes on gains in a regular account, fine. It's way better than losing money because you were afraid of taxes.
Okay, deal with taxes strategically. Third barrier.
Over-diversification. We touched on this. Conventional wisdom says spread your bets wide. Rule #1 says concentrate on a few businesses you know deeply. Put all your eggs in one basket and watch that basket very carefully. Also, forget those age-based allocation models. Rule #1 works the same whether you're 25 or 65. Find wonderful businesses at great prices.
So focus beats diversification. Number 4.
Your fund manager or financial advisor. Now, some are great, but many are incentivized to keep you invested with them, often in complex products you don't understand, charging fees. Rule #1 empowers you to take control, like learning to read replaced needing a scribe, learning financial literacy replaces needing someone else to manage your money based on flawed conventional wisdom. The tools are available now.
Become your own manager. And the final barrier, number 5.
Fear, that ERI we talked about, the emotional aspect of investing, fear of loss, fear of missing out. The whole Rule #1 system, the M's, the valuation, the tools, is designed precisely to combat this fear with logic, process, and objective signals.
So before jumping in with real money, the source heavily pushes paper trading. What is that and why is it so vital?
Paper trading is practice. It's absolutely crucial. You go through the entire Rule #1 process, find a wonderful business using the M's, calculate its sticker and MOS price, wait for the price to hit MOS, wait for the 3 tools to signal buy. But instead of actually buying, you just write it down, record the date, the hypothetical price.
Like a trading diary, but with play money.
Exactly. Then you track it. You practice selling when the tools signal sell or the price gets way over sticker. You do this until you're comfortable, until you consistently make money on paper. It builds confidence, works out the kinks, lets you experience small losses without real pain. It might take months, maybe a year.
And how do you know when you're ready to use real money?
You'll know because you'll start feeling genuine regret when your paper trades make big gains. You'll be thinking, man, I wish I'd used real money on that one. That frustration is the signal you've internalized the process and trust it.
Okay, paper trading complete. Confidence built. Next practical step. Opening a brokerage account. What are the options? What should listeners look for?
It's pretty easy these days. You need a broker to place trades. You've got full-service brokers, usually expensive, discount brokers, and online brokers. For Rule #1, online brokers are typically the best fit low commissions. $7, $14 per trade is common, and they usually offer good charting tools and data access.
What should you check when choosing one?
Look at online broker ratings, compare commission costs, check what account types they offer. Definitely look into an IRA, ideally a Roth IRA, for the tax advantages. See if there are account minimums, although many are low now. It's like opening a bank account, pretty straightforward.
And you mentioned limit orders and market orders?
Right. A market order just buys or sells immediately at the best available current price. A limit order lets you specify your price. I only want to buy if it hits $43 or lower, or I only want to sell if it hits $90 or higher. For Rule #1 buying, you'll likely use limit orders set at your MOS price or below.
And those trailing stops for managing risk once you own the stock.
Yes, trailing stops are fantastic risk management tools, especially once a stock is moved up nicely. You set it to trail the price by a certain percentage or dollar amount. If the stock keeps rising, the stop automatically moves up too, locking in profits. If the stock suddenly reverses and drops by your set amount, the stop triggers a sell order automatically, protecting your gains and preventing a big loss. It's great for peace of mind.
Now, for experienced Rule #1 investors who've built wealth, the source mentions a risky biz portfolio. What's that about?
This is strictly for advanced folks, people who've mastered Rule #1 and maybe want a little more excitement. It's for investing a small portion, no more than 10% of their total portfolio, in companies that don't quite meet the strict Rule #1 criteria. Maybe they're newer, high-tech, lack the 10-year track record, or are harder to fully understand.
Like maybe Google in its very early days.
Potentially, yeah. The rules are super strict. Max 10% of your money, use zero debt, absolutely no options or complex leverage. It's purely for potential high growth, acknowledging the higher risk. It's fun money after your secure Rule #1 foundation is solidly built.
Got it. Let's wrap up with some quick-fire questions that listeners might have, synthesizing everything. How much time does this take?
Initially, learning takes maybe 15-30 minutes a day. Once you have your watch list of wonderful businesses, it drops to maybe 15 minutes a week just to monitor prices and check the tools. It's very efficient long-term.
Should people just buy what famous Rule #1 investors recommend?
No. Rule #1 is personal. It must have meaning to you. Focus on businesses you understand and believe in. Do your own homework.
What about dividends? Good or bad?
It depends. If the company can reinvest cash at a high ROIC above 15%, we prefer they keep it and grow faster. If their ROIC is dropping, then yeah, give us the dividend so we can reinvest it somewhere better.
Best time to check the market.
When it's closed. Checking during the day just feeds your ERI, makes you anxious. Find a consistent time, evening, weekend, whatever works for you. Consistency, not frequency, is key.
Balance with bonds.
Rule #1 is about buying value. $1 for $2.50, whatever the asset. If bonds meet the rule #1 criteria, wonderful value at an M less price, then buy bonds. If not, stick to wonderful businesses on sale. Don't allocate just for the sake of allocation.
Can I buy at the sticker price? No margin of safety.
No. Always demand an MOS, minimum 20% off sticker, ideally 50%. They're not perfect. Things happen. The MOS is your protection. There will always be another opportunity if one is only priced at sticker.
What about ETFs or REITs?
You can apply rule #1, evaluate an ETF or REIT company using the 4Ms and Big Five. For REITs, you're valuing the company that owns the real estate, not the property itself. The tools work well on liquid ETFs too.
And DCA, dollar cost averaging, still useful?
For a rule #1 investor, nope, irrelevant. We know the exact price we want, MOS price, and use the tools for timing entry near that price. So don't buy blindly at any price. #tag outro.
Wow. So we've really dug deep into rule #1 investing. We've seen why old approaches often fail, and we've gained this really robust framework for success. Buying wonderful businesses at attractive prices, guided by meaning, moat, management, and that crucial margin of safety.
Exactly. And you've learned how to quantify that wonderfulness with the Big Five numbers, how to check management integrity, and critically, how to protect yourself with the margin of safety. Plus, you now have those 3 tools, MAS-CD, stochastics, moving averages that let the individual investor potentially sidestep market noise and emotional traps.
This feels like more than just investing strategy. It's about financial literacy, taking real control. And the journey starts simply. Clear bad debt, practice with paper trading, set up that brokerage account. The market will always be there, always offering opportunities for wonderful businesses on sale to those who are prepared and patient.
And remember the goal: certainty and low risk, leading to potentially high returns. The aim is to reach a point where you truly don't have to worry about money, freeing you up to pursue what really matters to you without that background financial anxiety.
So as you, our listeners, start thinking about this, here's a final thought. If approaching investing like a smart shopper looking for fundamental value in businesses, not just chasing stock prices, can be so transformative financially, where else in your life could shifting focus from complexity and speculation to fundamental value make a real difference?
The knowledge and the tools are out there, accessible like never before. The only question left is, how will you use them to change your world?